So, hello everyone. Carlos here with the Evolve Commerce Club. Today we are hosting another expert session number 63, if I'm not mistaken. And today we're gonna invite Ignacio, who brings over 180 deals under his belt in terms of M&A. But before we start the session today, I want to talk about the Evolve Commerce Club. And so the Evolve Commerce Club is a club for senior professionals who built their careers and companies across international markets. We bring people with over 12 years of experience in commerce, digital retail, tech, and people who value signal over noise. What unites us is curiosity, generosity, and a shared belief in long term thinking. We're not a networking group, and we're not here. Evolve exists to create real conversations, meaningful introductions, and long term partnerships. Every week, we host expert sessions like this one with leaders from companies like Alibaba, Nike, Carrefour, and many others. So, we also run one to one curated connections and host in person gatherings in cities like Sao Paulo, London, Stockholm, and more to come. We are now 426 members across 43 countries, growing by recommendation, not promotion. If this feels like your kind of place, you're welcome to hit me up or Gustavo, and now we'll start. Gustavo and Ignacio, you're very welcome to start now. All right, so Gustavo and Ignacio, welcome. Gustavo, maybe you want to lead the session today. I'm going to be more like quiet. And
yeah,
what?
Sure. So let me first present Ignacio here, who's with us. Let me just get here my clue that I have. So we're receiving today Ignacio. Ignacio is Ignacio Villanueva. Ignacio combines deep expertise in tech-focused M&A with a founder's first perspective. He's advised entrepreneurs through complex deals involving roll-ups, strategic buyers, and private equity across SaaS, e-commerce, and marketplaces. Before joining L40, he led fintech sales at Fuel, that was later acquired by Factorial, and built a career as a professional athlete representing Spain at the Olympics in Rio. With an MBA from Garrigues and a background in law and business, Ignacio brings a rare mix of precision, performance, and real-world experience to every conversation. So, Ignacio, welcome. And well, we like to start our expert sessions with a, let's say, powerful question. And this one is for you is so given the industry's obsession with financial synergies and cost cutting post M&As, should investors take moral responsibility for the innovation debt created when acquisitions prioritize short-term ROI over retaining the talent and culture that made the target valuable in the first place?
All right. So first of all, thank you very much, Gustavo and Carlos, for having me on today here. Before answering the question, I wanted to share a little bit of background about myself before joining L40, where I'm a partner at. We're a sell-side, cross-border sell-side M&A firm. So we have offices both in Europe and in the US, and we're helping founders go to market. Before that, I was part of Bupos, which was a fund in the M&A space. So we raised a 250 million fund. And the journey was quite interesting because we started lending to e-commerce. People that wanted to buy e-commerce around the world, they would come to us, so we would finance the acquisition. So typically we would finance between 40 and 60%. The investors or the buyers or our clients would invest usually 20% of equity, and then the remaining would be a combination of seller note, earnout, or rollover equity. So we've kind of seen every transaction, every type of transaction in the tech industry. We lend to e-commerce, SaaS applications, mobile apps, SaaS, and all kinds of tech assets. So I think that journey was quite interesting. We very recently sold that debt portfolio to Founder Path, Nathan Latka, and now we're enrolled in this M&A journey to help founders exit. So to answer your question, I think as all the US people usually say, cash is king, right? And ultimately, you want to maximize ROI regardless of the changes that you have to do within an organization. It is true, and I've been part of organizations where at first, when the company is small, there's a lot of impact done by people that are not, they don't have that much experience, but they have the thrive, they have the energy, and they want to put everything that they have into the business. But once you scale, it is true that you need a different type of employee, different set of skill sets, and different people that know how to take the business from 1 to 10. So there's a different skill sets that you need from 0 to 1 to 1 to 10 to 10 to 100, right? And it is true that you want to respect those people, but at the end of the day, we're here to do business and increase the ROI on every single business. So as hard as it may sound, I still believe that you have to do the right thing for the business. And if the right thing for the business means moving along from the people that took the business from 0 to 1, that's what you have to do.
Great. Yes. Well, I agree with that because it's like yeah. So the what made the company get to where they are. It's not what will make them go further, right? Go to the next step. So I believe it's also a matter of fact of it's also a question that is the company or are the people, everybody able and capable to change the culture. So the company needs to basically kill themselves every day to be rebuilt every day, right? So
Yeah, I mean,
self-rebuild every day.
I always like to take everything on a sports level. Given my background in rugby, if you think about it, if you're a rugby team or a soccer team, NFL player or anything, and you advance on the league, you always want the best players on the team, right? You're not going to say, hey, look, we were playing in the second division last year. We're now in the first division, but we're going to keep the team that took us to the first division. I mean, you're going to take the best players from that team, right? But that gives you a little bit of more cash. That gives you the ability to go out to the market to get the best players. And that's what you have to do if you want to thrive in the first division. Unfortunately, you can't do it with the same players, right? And that's harsh, but it's the reality. And I think it's the right approach. If I was the coach for a team that went from second division to the first division, I'll start looking for the best players that I can get for that new journey.
Yeah, and well, and if you have if the players that you have, they are capable of evolving and growing with you, that's wonderful, right? That's great, but unfortunately, that's not the history for everyone, right?
Exactly.
And well, let's get a bit more in terms of let's say technical questions regarding M&As, because this is something that's interesting and something that we have a lot of companies in our community that are that looks for investments, for exits, and of this type. So looking for M&A, so what specific and operational milestones like recurring revenue, thresholds, customer retention rate, customer retention rates, right? Do you consider critical for a tech company to be acquisition ready? So for the company to be ready to be acquired or to have an interest in M&A?
Yeah, no, absolutely. So what we've seen on the market so far, I would say the first minimum threshold that could be a good sign to show that you're ready for an exit would be 3 million ARR. It seems like both strategic buyers and financial buyers find that minimum threshold a good sign of, hey, you already have a decent side, you've already shown product market fit. And I would say the closer you are to 3 million ARR, the better equipped you are for a full M&A exit. Now, that doesn't mean that if you're below 3 million ARR, you shouldn't consider an exit, because obviously there's tons of players out there who could see your technology and want to buy you out. There are some financial buyers that are also interested in doing add-ons to their existing portfolio and would be glad to look into your company. But as a general rule, 3 million ARR is kind of like.
Oops. Sorry. Ignacio, you.
We lost him. Yeah.
Am I muted?
Yeah. You were mute. You were in mute.
Oh,
no, it's okay.
Okay. All right.
Perfect.
So yeah, I would say 3 million ARR is the first sign. The second one, it's rule of 40. So I would say first tier of metrics that buyers, both strategic and financial buyers, are now looking into is first tier is rule of 40, NRR, and GRR, right? As a general rule of 40 is when you add the percentage of growth on a year-over-year basis plus the EBITDA margin from last year. That has to be at least 40. So let's say, for example, that you've grown 20% on a yearly basis and you have a 20% EBITDA margin, you're right on the rule of 40. If you're growing at a 60% year over year and you have a 20% EBITDA margin, you're at a 80% on the rule of 40, and that's a really good sign. Now, the interesting question here regarding the rule of 40 is what weighs more? Is it growth or is it EBITDA margin, right? So is it the same weight if you're growing at a 30% year over year, but you have a 10% margin? Or does it weigh more if you have a 20% growth and 20% margin, right? So there's not a clear answer. And I've asked this question to a lot of buyers out there to try to understand what weighs more into the market. And we can talk about it later, but there isn't a defined rule that it has to be balanced out. What buyers seems to be very aligned is that if you are, let's say, growing at a very high growth, but you don't have profitability, that's not a good sign always. So buyers in the M&A space are looking for profitability. A path to profitability is not like the VC world, is quite different. So you want to make sure that you have signs to reach to profitability soon if you're still burning cash. Then the next KPI is NRR. NRR is essentially your ability to upsell to your existing customers. And we've had a lot of discussions very recently with founders, and I've seen that in the market, founders are not measuring it correctly, or I don't want to say correctly, but at least they're not measuring in the same way that buyers are looking into it, right? So just for everybody here to be clear on how NRR is calculated, is within your existing customers, you got to take the revenue from those customers, you add the upsells, and you have to decrease the downsells and churn from a specific period. So that means that the new clients that are coming in within the period that you're analyzing the NRR does not involve in the NRR. So you cannot take into account new revenue from new customers in order to get that NRR. Now, the NRR metric, I would say market standard has to be at least 100. So I would say if you want to see what's a good NRR for the market, I would say from 90 to 100, it's something that you're going to get a lot of questions from buyers, and they want to really look into why that's the reason, because they want to see at least 100% NRR, which means that from your existing customers from 1 year to the next year, you're able to upsell to those customers. A good way to looking at it would be, hey, if you right now, if you go to COVID and you cannot put your sales team out there in the market contacting new buyer, will those existing customers that you have, will they make you increase your P&L or will they make it decrease? So if you have a NRR which is 100% or above, and you don't have a sales team all of a sudden, it's not such a high risk because you're going to have customers that are constantly growing and pulling more revenue for your business, right? So that's NRR.
Yeah. Great. And let me ask one question, one doubt that came to me. So if we have if you have like a transactional platform and you have this client, and so if this client grows, so 1 year he's, let's say he's transacting more like let's take yeah, I don't know if payments solution would be a great example, but if you have a transaction platform and this client is making you like 50 million per year, and in the next year this client grows, and but with that same contract, same things that you had, but he starts giving you like 100 or 80. Is that considered into this NRR, or it needs to be like another contract with another product or an upsell that you do or something like
It's considered on a customer basis. So
that?
if let's say you have a main product, but you have additional usage of your software that you can have your customers pay more for, then that's considered NRR. So any expansion from existing customers will be included into the NRR calculations.
Great.
So
Great.
next in line is GRR, which kind of measures the same as NRR, but you're not taking into account the upsells. And the general metric for that is 90%. You want to make sure that at least you have a GRR of 90% in order to be considered a good.
Okay, so this what I asked you is more like it's the GRR, right?
I mean, if
Would
you're
be
upselling
considered.
to the same customer, that's considered NRR because the GRR doesn't take into consideration upselling to existing customers.
Yeah. Okay. Yeah.
And then
Perfect.
that would be those would be like the top three metrics that are on the first tier when buyers look into any business. And then on the second tier, you're gonna see client concentration. And what you want to do here is, all right, you take the 5% of your top customers and you make a graph, right? How much do they represent out of the revenue? And you do the same with the top 10 customers and the top 20 customers. So you can easily see where's the revenue risk if a certain customer churns, right? And that's something that buyers are also gonna look into, and it's a very good KPI in terms of your client concentration. What does your 5% customer make in terms of revenue, top 10%, and top 20%? And then also
Yeah.
client diversification, which means, hey, where are your customers located? Are you selling only in Europe? Are you selling just in Spain, just in Germany? Or do you have clients in the United States? I would say that as soon as you're able to get clients from the US, as the US represents a big market, and as we'll see later, TAM is one of the most important metrics also the buyers are looking into. If you're able to tap that one customer, that market in the US, you automatically get a premium on valuation.
Great. Yeah, and yeah, that leads me to the next question when we're talking about valuation. So I would like to ask you at first, which are the how do you calculate the value of a company? What is the number? How do you calculate that? So I'll stick to that simple question before, and then I'll lead to the next one. So how do you calculate the value of a company?
Okay, so first of all, you have to get all the metrics and the financials from the customer, right? That's a very recurrent conversation and something that perhaps we made a mistake early on our journey is everybody wants to see a valuation. They want to know how much their business is worth, but they want a easy calculator that you can get online. You can plug a couple of numbers and then that spits out a potential valuation, and that's what you take home, right? I really wish it was as simple as that. So if you're trying to get a valuation, if you're interested in getting a valuation, someone that has a calculator online that spits out a valuation without really understanding the numbers, you cannot take that valuation seriously. So if you want to go through the process, make sure that you contact somebody that's going to ask for all the information, balance sheet, cash flow, P&L, client retention rates. It's able to do the NR, GRR analysis, churn analysis. But essentially, what you want to do is you want to, first of all, you want to see what publicly traded companies are trading for in the same space to kind of get a sense of the multiples of the more mature companies in the space, right? Then you compare to private transactions similar to your business size, regions, and clients. And you want to look at those multiples as well. And then finally, you want to do a discounted cash flow process in order to see what potential valuation you could get for your business. And then what we're going to see, or what we're going to apply, is those same metrics that I mentioned in the first question. How do they affect the total valuation? So if you have an EBITDA of, let's say, 1 million, and publicly traded companies or private companies have traded at 10x EBITDA, not always you can expect to trade at 10x EBITDA. You want to go see, all right, what's your client concentration risk? How much percentage of your revenue is coming from one single client, or top 5% client, top 10? You want to look at NRR. All right, you have 1 million EBITDA, but is your NRR above 100%? Is it above 110%? What about your GRR? What's your revenue growth? What's that rule of 40 look like? So when you take that in consideration, you're going to see, okay, if you have your NRR above 110, if your GRR is above 100, if you don't have any customer concentration, if you're selling in the US and in Europe, so you start to add all those things that I mentioned early on, and you're going to apply those same metrics to the traded multiples that you see from comparables, right? So that will allow you to be, let's say, above the mean and the average on the private transactions, or below, depending on the previous metrics that I mentioned. So that's usually how we come to a valuation.
Great. And yeah, so, and beyond the financial aspects and metrics of the valuation, what non-traditional factors are increasingly driving premium valuations in tech M&A? If so, I don't know, AI capabilities, is the I don't know, the founders or the team that are very influential inside the segment or the sector. So what are there any other factors that can increase the company's valuation?
Yeah, absolutely. I would say, first of all, rather than what are the factors that increase, I'm going to start with what are the factors that are going to assure that your valuation, it's right on what your business metrics would give you, right? Because you could have a good NRR, you can have all the above that we mentioned, but there's some couple of things that you want to also make sure that are not accounted for the financial, but they're going to set the floor. So first of all is clean financials. So we've seen a lot of times where all the metrics look amazing. It's a great product market fit. They've grown, good NRR, good GR, but the financials are just a mess. They're doing cash accounting instead of accrual. They don't have audited financials. They don't have everything clean. They don't have a ERP or CRM with the financials. So you want to make sure that your financials are as clean as your product market fit. Right, that's a very important aspect that goes into evaluation. And then the rest of the things are just going to be, all right, can someone else take the role of the CEO? How dependent is the business on the current CEO? And is there a second layer of management team that can step up post-acquisition? Because you want to make sure that, hey, if you're selling your business, the business can continue without you, and that you have all the process well documented in order for anyone to come in and start doing basically what you've done. So you want to make sure that you start teaching your second line of management how to run the business without you. That's a very important aspect. You want to make sure that everything is well documented on the process, the code. The code also is updated to the latest version. You haven't had any breach in security. You have everything that could mean any breach in security well defined and well, let's say, closed up. And then also the pipeline. If you have a good pipeline, if you could show, hey, there's a good pipeline, and the TAM, the total addressable market, obviously, I guess that's something that you cannot control once you enter an industry. It is what it is. But it seems like that's always been a good driving factor on valuation, that it's outside the metric. So whenever you start thinking into how to develop new apps or where to get in the software space, the first thing you want to look at is, all right, what's the total addressable market? because that's what buyers are going to look for once they've covered all the metrics. All right, you've got a good product market fit. All right, you've grown, you have the code updated, clean financials. There's a second management team that can take place. Well, what's the total addressable market? Is it big enough? Can I grow this business to what I want it to be, or is it just very small? So I would say overall, those are kind of good metrics that you can start thinking about if you're thinking about selling the business outside the financials.
Can I ask a question that it's
Please.
not in the it's not in the clue that Gustavo shared that, but I think it's related to what you're saying because and I'm sharing this being a founder of Evolve and Gustavo a co-founder here. So for example, we believe we are creating. You have all sorts of networks, okay, of networks out there. So you have networks for hiring, networks for whatever, and we believe what we are creating is very unique, meaning of course we are in a space which is the digital commerce space, which is our background. We comes from digital commerce. Um, there's an aspect of what we do that is about careers, international careers, but there's also the aspect of business acceleration and partnerships. We see that these things are connected, and so I'll get to my point. My point is the value of creating a category, something new in the market, and the value of brand. And how do you guys evaluate that? Because let's say that we were looking at a strategic buyer, we don't necessarily have. We have a pipeline today. We have members that are looking for a company, but we could also have more like a strategic buyer. We wouldn't be in a position maybe to do an exit, but a strategic buyer, that says, hey, this what these guys are doing can really accelerate what we are doing here because they can accelerate hiring, they can accelerate our market presence, whatever. And it's more like your take on that. It was not in the script, but just to pick your brain and see if we could expand a little bit on your views on that.
No, absolutely, Carlos. That's the goodwill and the intangible assets, right? Every time we do evaluation and we go through the process, we look at what I mentioned, right? Private transactions, publicly traded transactions, and all the metrics. And we kind of give a range and we say, hey, your business, we believe your business is sitting between, let's say, 15 million and 20 million, right? That's usually the range that we give, well, usually depending on the size of the business. But then we always leave a space to exactly what you're mentioning, right? And when you look at what strategic buyers are looking for and all the past transactions that strategic buyers have done in the past, it's not trying to increase what your market already, right? So it's not buying your competitor, it's buying what you don't have and what allows you to kind of cover that 360 degrees product business roadmap. So strategic buyers are looking into what they don't have and what could really increase what they're offering to their customers, right? And that's what makes strategic buyers the ability to pay a higher multiple than financial buyers. Because financial buyers, at the end of the day, they're going to look at how much cash flow you're generating, how much cash flow I can increase with the people that I have, with the knowledge and cross-selling to my existing customers. And I'm going to do a discounted cash flow analysis to understand what's the business value of the business now. But strategic buyers don't look at that. They see, okay, if this is a strategic fit, I'm able to overlook at that discounted cash flow that the same financial buyers are doing. Plus, I'm going to add, let's say, a premium for what I believe I want to offer, right? So, but that's very intangible and that is very specific for every single buyer out there. So it would be, let's say, it would not be fair if I came to you right now, Carlos, as I said, hey, your valuation, it's between this and that, because it's very hard to understand what future buyers that you're going to talk to are going to value what you have, which is unique in the market and could really make that specific buyer increase what they're offering and is specifically what they're looking for and how much more they're willing to pay for what you have, right? So when we engage in a conversation on valuation, I'm going to tell you financially with a small strategic approach how much the business is worth, but you cannot really put a price on that intangible for a specific buyer, because some strategic buyers might look into it and say, hey, this is going to represent 30% increase on what I already have, and thus I can offer much, like many millions more for this business. And other strategic buyers say, okay, it would be a nice to have, but it's not a must have. So I'm willing to pay just a little bit more. So it's really hard to try to put that into paper on what the goodwill is going to be for all the buyers in the market.
Really, thank you.
Great. So as we're talking about the investor perspective now, let me give this this view in terms of looking at the investor side. So when evaluating the potential investment, what do investors or do you at L40 prioritize? Is the market size or the operational scalability, especially in today's world climate? So climate in terms of world situation and all of this organization or disorganization and reorganization.
So that's a really interesting question, just because I just spoke to a big financial buyer yesterday, and I was trying to understand what weighted more in the rule of 40, right? That's something that we touched upon the first question. Was it the year-over-year growth, or was it EBITDA? And the answer that she gave me was that they're looking at the TAM more. So I would say once you've covered the essentials, which is those metrics that we've been talking over and over again in these conversations, the next point is, all right, how big can this project be if I buy it, or if I take it on, right? So I would say that TAM, once you have covered the minimums, TAM really becomes very, very important and essential in evaluating a business. So definitely, especially for those bigger acquisitions, TAM and the ability to cross-sell to your existing customers are two of the most important metrics, because the rest is just assumptions, right? You already have the assumption that you have a minimum level of EBITDA, minimum threshold of revenue, and that the retention and all the metrics are going to look good enough.
Great. Yes, and now following into the investor's perspective. So, what I don't know if what you've been seeing or what you're more used to, but because we have investments and M&As from companies that are looking to expand their markets, reach more markets, or go deeper into their market that they already are, their vertical. So they start buying some other companies. So you have an enterprise company, and then they are big, and then they start buying other companies looking for the SMB markets, and they start building all of this chain of products that will potentially that they could be together with this client, since he's a small client until he becomes an enterprise client, possibly. Or what you've been seeing in terms of that, it's more like this, companies trying to get deeper into their market, or is company, or are for so just investors that they want to buy companies and accelerate that on companies. So not connecting a lot of companies to do one company, but investing money and making that company even bigger.
Yeah, so I would say over the past few years, we've seen an increase in the number of financial buyers. We usually make the differentiation between financial buyers and strategic buyers, right? And over the past few years, we've seen a big increment or increase in the number of financial buyers that we see on the market. So in terms of volume, dollar-wise, strategic buyers are still accounting for the vast majority of the transactions. But if you look at the number of transactions, especially on the lower end, you're gonna see that it's about 50-50% on the number of transactions. So there are an increase on the number of financial buyers, and obviously strategic buyers have always been there, but we see more and more that there are a lot of financial buyers looking for SaaS businesses, tech businesses, and especially on the lower end. But for those, they're looking for an ROI, so they want to see that EBITDA, that path to profitability that we talked about. So this conversation is linking to the beginning of the conversation. If you want to maximize your chances of selling the business, you want to make sure that you're both attractive for strategic buyers and financial buyers. And if you want to increase your chances because you want to be attractive for both strategic and financial, you want to make sure that you're EBITDA profitable, that you have that rule of 40 well balanced out. So that's kind of how the conversation links to what we're talking about right now.
Great. And yeah, on a more, let's say, personal question in terms of looking for the founder's situation and position, does that also differ when he wants to? So, okay, I have this company. I want to have an exit, or okay, I want my company. I want to do a merger, and I want to continue with the company within. Does that also influences this?
Absolutely. And that's one of the conversations we always have with founders when we start engaging with them in early conversations. You want to make sure that you're working with an investment bank that understand what you really want to do and what's your ideal situation. And that's something that I always tell my clients is, hey, I'm not here to tell you what you want to do. You have to tell me what you want to do. And if what you want to do is, hey, I want to sell 60% of my business and I want to continue working for the next 5 years within the business and sell again in another 5 years, hey, we're going to position the business. The whole go-to-market strategy is going to be around that. But if you tell me, hey, Ignacio, I'm just tired of working or I have other plans for the future, I want a clean exit. I want to be out of the business by the next year. Then my whole strategy, the whole communication that I have with strategic and financial buyers are going to be around that. So what you mentioned, Gustavo, is very important for you to align with whoever you're working to help you exit, to make sure that the communications and you're very upfront with the customer, because what could happen if you're not transparent with both your advisor or with the buyers is that you'll start engaging in conversations. You might even end up with an LOI, with an offer, or even a situation where you don't want to move forward because it's not really what you wanted at the end of the day, right? So you want to be upfront about it. There's not a right or wrong answer here. It's fine if you want to leave in 1 year. It's completely fine if you want to keep on working for the next 5 years. Completely fine if you want to sell 100%, 80%, 50%, or 40%. There's not a right or wrong answer. It's just about, hey, what do you want to do as a founder?
Yeah, it's just more of being transparent and clear, right?
Exactly. Yeah.
Also, you have if you stay in the company or if you leave the company, you have also the expectations from the investor. Is also investing. So okay, so you leave, but what type of company are you leaving to me, right? And if you're staying, what type of partner will you be, right? So will you be willing to help us grow, or will you be? Yes.
If I had to say what I see more is I see more founders telling me, "Hey, Ignacio, I'm used to being independent. I've been a founder for 10, 20 years. I'm not used to having a boss. I'm not used to reporting to anybody. So as much as I believe on this company and the potential, once we do the exit, I don't want to stay more than 1 year. That's usually what I see. Because and I understand. I mean, you're independent. You're used to not giving anybody excuses or explaining what you do or what you don't do, and changing from one to another could be different.
Ignacio, I have can I ask a question, Gustavo? Please.
Yeah, please.
Sure. So my question is more like about some real, let's say, world cases that you've seen on the good side but also potentially on things that were also not so positive. And on that note, I've watched there's a couple guys in Brazil that I really enjoy their show, and they talk about M&As, about the typical emotional roller coaster that they go through, because typically buyers, they're less anxious, I guess, than the ones who want to sell, or it depends on the situation that they find themselves in. But a lot of sellers, in that case, the stories that I seen, and the podcasts that I consumed, they talk about the emotional roller coaster that they went through, and then I think it's quite fitting, the position of the advisor there, to be kind of like the bad cop, right? Because if you go there, let's say naked, and you just try to negotiate the deals by yourself, you're probably gonna face some situations that you're not fully experienced. And I mean, Gustavo and I, we have this conversations. Sometimes we have to talk to clients and say, "Today you're the bad cop, man," because we're doing, most things ourselves. So that's very important role. Like, not you know what I mean? So
No, absolutely. It's funny you mentioned it. I just posted something on LinkedIn a couple of weeks ago where I said there's a picture of me when I had hair and now when I'm completely bald.
I saw that.
And I said, hey, founders, don't lose your hair over an M&A process. Let someone else take the hit, right? And I was exactly referring to this M&A process. It's a roller coaster, man. I still live it every day doing M&A. One day you receive a lot of offers, seems like the deal is moving forward. The next day you'll find something in due diligence that kind of makes the buyers hesitant and not wanting to move forward. You lose the deal, you regain the deal, a buyer comes back that you thought it was lost. You have some frictions on due diligence that you want to argue about. And as you mentioned, you want to have someone that fights the battle for you, especially if there's a transition period. You don't want to get the argument too heated and the relationship to start going south. You want to make sure that you have someone that's fighting the battles, that is going to look for as the bad cop. And once you make the completion or the transaction, the relationship is going to be completely fresh, is going to be new, and there aren't going to be these friction moments, which is the advisor who's going to lead them for you, right? But yeah, it's a very, very emotional process. There's a lot of back and forth. It changes quite a lot during the process, and there's a lot of nuances on the process that you want to make sure that you have somebody that has gone through those nuances and has seen it before, to know how to adapt, how to respond, and what battles to fight for harder than the others, which are more market standard, right? So yeah, I would say that having an investment bank, it's very important. But again, I'm an investment bank, so I'm always going to sell you what I do. But I really believe it, that if you're going to go to market, you want to make sure that you have somebody by your side. And one last question, one last comment is, it's interesting because the more buyers are interested on the deal, the more they're going to pursue you, right? So if they're really, really interested on buying your company, you're going to know, you're going to feel it. They're going to be all over you. They're not going to let you breathe. If there's a small change in the terms, they're gonna be okay with it. So it's just like when you're trying to meet a girl, if she's into you, you're gonna feel it, and it's the same for the buyers. If he's really into you, you're gonna feel it throughout the whole way.
Very good. Go ahead,
Yeah,
Gustavo.
and great. And well, we have talked about this, and we have started talking about the integration or not of the founder. We touched this point, but in terms of integrating companies, and so what's one tactic for retaining during post-acquisition integration, because it's such a thing, right? As you mentioned, it's because one thing is what we touched already is the founder side, so he can be stay or not, but you have also the team side, right? So what's some tactic, what have you seen, or even also do you guys work with that also, or have you had prior experiences in these part, so in the post acquisition?
Yeah, so that's I would say a very taboo question because nobody knows what's going to happen post acquisition, right? Everybody enters the deal thinking that it's a win-win for both teams, but the reality is that integrations cannot go as planned, and that is the most important aspect of an M&A transaction, which nobody talks about because nobody sees the aftermath, and nobody kind of everybody knows multiples, exits, etc., but they don't tell you the full story of what happens post acquisitions. This is something that we lived very closely when we had our previous fund because we deployed capital for the acquisitions, but then we serviced the debt post acquisition. So we kind of saw what happened on different strategies once you buy a company, right? And that's very important. Like big companies have M&A teams, but within those M&A teams or corporate development teams, you're going to have integration members who only step in once the acquisition is made, and they make sure that the integration is fully completed. I would say that this is a very important part that you want to talk to while in due diligence, while engaging in conversations, even before or after LOI, because the roadmap for integration has to be agreed by both parties. It has to be well thought of, and it's something that you have to discuss even before signing the agreement, right? Because it's going to be everything depends on it. For the buyer, obviously, the ROI that they take depends on the integration. For the seller, if there's an earnout component, the integration, you want to make sure that it's the most efficient and best way to integrate both companies. So I would say there isn't a magic word that I could say regarding the integration. I would say it should be a very well thought of conversation to have between the buyer and the seller as early on the process as possible to make sure that you're both aligned and you're thinking about it from the beginning.
I think
Great.
on, on the earnout note, what is the advice? Because that's I have
I
seen
was
stories.
going I
Yeah,
was going
sorry.
to ask exactly. I believe the same thing because I was going to ask you exactly the same thing because I've
Uh-huh.
seen so many people selling companies and doing M&As, and a year later, when you talk with them, they're so, oh man, this is crazy because it's the period for my earnout, and it's stressful. I need to work. I need to do things. We're reviewing the spreadsheets and etc. And well, this was my question. So, what would you be? Why is this such stressful 1 year later? And if so, if it's 1 year or the quarter
You know
time, yeah.
that's also something to think about when deciding who to go with, right? As I mentioned earlier, you have strategic buyers
Mhm.
and financial buyers, right? Strategic buyers are usually going to pay a higher multiple, but they're going to want to integrate your technology within their portfolio. And as we just mentioned, integrations can be difficult and sometimes ruined if not done well, which means, and financial buyers are not going to integrate your company. They're just building a portfolio of multiple companies to have a good cash flow and a good return of investment, right? So most likely the integration between a financial buyer and a strategic buyers are not going to be at the same level, or they're not going to be as
Mhm.
complicated. So that means that as good as an strategic offer might be, the risks of getting a payout from an earnout component can be much difficult if you're selling to a strategic. So you have to put everything on the table and decide, okay, the offer from the strategic might be higher, but they might require me to work for 2 or 3 years, which I don't fully want to do. And there's a risk of integration and my ability to get access to that earnout structure or that earnout component. Whereas for the financial buyer, they might not require you to work 2 years post acquisition, but only one. And the earnout component might be much easier to prove or get access to. So at the end of the day, it's very difficult. Obviously, not every situation is the same. Not every founder is the same risk adverse. So you
Mhm.
just have to put everything on the table and decide what's best for you.
But my question on the earnout, which is a segue to Gustavo's question, is more like there's this sort of date. The buyer knows I'm very sexy and they need my technology. It's going to be very important. Is the earnout, mandatory? Does it always happens, or can you balance it out also in during the negotiation process and say, okay, we're going to sell it. You're going to pay a higher multiple here, and then my earnout. And this is, I have never done this. I heard stories, but I'm curious, like, to say, okay, it's fair to have an earnout, but can we say that the earnout, instead of saying, okay, 50% of my payout or my exit is going to be tied to the next 2 years bonuses, or however you name that, it's just going to be 20%. So I can make more money during this acquisition now. And then that's also a negotiation, no?
Absolutely. It's a private contract between two parties, and you could do absolutely whatever you agree to. So in the common law, you could do whatever. It doesn't have to be an earnout component. As a matter of fact, we just sold the business for 15 million. There isn't an earnout. It's just a seller note where, hey, you have to pay X amount after 1 year, regardless of the performance post-integration or post-acquisition. A good note on the earnout, which I already mentioned, it doesn't have to be mandatory. You don't have to structure a deal with an earnout. But if you do, make sure you base it out of revenues and not EBITDA, because we've seen a lot of times where founders negotiate an earnout based on EBITDA, and then the buyer starts hiring more people, starts putting more money into marketing, and obviously the margins contract, and then you don't get access to your earnout. So very basic concept. If you're going to do an earnout, which you don't have to, make sure you do it out of revenues. And then apart from that, the deal structure could be with different shapes. It could be everything up front. It could be a component on earnout just on the first year. It could be a seller note for the next 3 years. It could be a seller note with interest. Hey, if I'm going to finance, let's say 30% with a seller note, you might as well pay me interest, right? That's something to take into account. Or you negotiate the salaries as well. You can negotiate an uncapped earnout, for example. Hey, if revenues are above this threshold, the remaining amount above this threshold, I'll get everything, right? So there's multiple choices as we've seen everything.
Brilliant. Yeah, I have a final question. Then Gustavo, maybe if you have questions to finalize. But my question is a very selfish one, based on what we do and our club. And we believe in this is the time to go global, to expand your business. It's always the time. I think that always creates value. But I like to hear from you. We're gonna create a nice snippet with what you're gonna say here. Why should your business go international? And do you think that is a need and that creates value? How do you see that? And if so, instead of saying a lot of stuff, I would like to hear your take on why companies should go international. Yes.
So first of all, diversification, right? And you're talking to somebody that we from Spain started a 250 million fund. And from the beginning, we said we have to go to the US, right? The US is always the biggest market. It's very hard to get into, but once you get into it, the possibilities just unlimited, right? You got to think how we operate in Europe. You have Germany on one side with the language and their laws. You have France, you have Italy, you have Spain, you have Greece, you have the UK. So there different laws, different jurisdictions, different languages. You got to hire different teams on all the regions, where in the US, same jurisdiction, same law, same language, right? So you want to make sure that you want to get there. Diversification, there's just the number of opportunities you can tap once you diversify your business are amazing, right? So if you can get X amount of clients in Europe, you can get twice as much in the US. And also in South America, which there are some great markets out there that are growing very rapidly. Asia, China, what's happening with China. So at the end of the day, it's just a matter of diversification and opportunities that you want to tap into to increase your chance of success. I'm a big fan of going international and looking for new markets. I think those who stay in one specific market, you have a high advantage against them. If you kind of move away from that and start diversification, it's very complicated. You're going to suffer the first few years, but ultimately, if you can crack the code on any other region, your opportunities are just going to increase 10 times, right? And I'm very fond of that.
Brilliant.
Great. Thank you for this, Ignacio. I have two more questions. And one's more on a personal side, but I will leave to the last one. And now I have one question, which is, what's the most counterintuitive, if there is, trend that, as you guys in L40 has observed in 2025 in terms of M&A's activities?
What's the most counterintuitive trend? Traditional businesses.
Yeah, this is
roll-ups in the traditional business space, and that's coming from someone that specialized in tech. But if you want to succeed on the M&A, if you're looking for a good strategy, start buying traditional businesses. I'm a very huge fan of Cody Sanchez. She's always telling you about how many opportunities you see outside tech on the M&A space. So that's a very counterintuitive trend, but it's always a safe one and a good one. So I think it's funny coming from somebody that specializes in tech. But I mean, there's a lot of people retiring for their smaller companies. Nobody wants to have a laundromat. Nobody wants to do these jobs. And if you can find a really niche, small company locally, you could do a roll up in this space. You're going to have a lot of chances, a lot of opportunities, and not a lot of competition.
Great. Thank you. And the more personal question, I believe, is not something, well, I believe it's more interesting. And you have a background as an Olympic athlete. So, what's at least one or three biggest learnings that you bring from this experience to the business world?
So I would say, all right, first one, you have to constantly work, right? You have to outwork your peers. You gotta find this one is something that I really liked. So when I started playing rugby, you got, or any other sports, you have the sport and then you have the weight room, right? Everybody thinks, hey, if I play soccer, if I play football, if I play tennis, I'm gonna be good. But if you don't do weightlifting aside in today's world, you're not going to thrive, right? There's nobody in the NBA that doesn't go to gym. There's nobody in the Premier League that doesn't go to gym. And there's no one in the Olympic rugby team that doesn't go to gym. So you got to find that what's your gym within your industry. And going to work 9 to 5 isn't going to the gym. That's training, right? You got to either read books on the side. You got to listen to podcasts that talk to you about how to grow business, how to do sales, how to whatever, finance, whatever your industry are, you got to find what is the gym that you can go to after work and thrive while people are just training. You want to make sure that you out train them in the gym, and you got to find what's your gym personally for you. The other next thing is, when I was a rugby player, I wasn't the greatest player on the field, but I did a few things that were very, very important for the rugby team very, very well. The rest of the game, I wasn't as great. I wasn't the best player or anything, but those two small things, I did so well that they kind of got me a spot on the roster. So I would say you gotta find those 2-3 things that are crucial for your industry, and you got to do them very, very, very well. The rest of the things, you don't have to exceed on every single aspect. Just find what you're good at and make sure that you're good at those small things, because they can make up for a lot of things that you might not be as good at on other aspects. So that would be the second. And then the third one is just keep on trying. Just you got to make mistakes, man. You got to make mistakes. I'm gonna talk a small story about my rugby. I remember we went to a tournament and I was trying to practice this cross back pass during the whole tournament before going to the tournament that would take us to the Olympics, right? And I remember I dropped like 20 balls during the tournament, and I told the guys, "Hey guys, thank you for taking me to this tournament, so I can fail, and I can make these mistakes on the pass." And funny enough, when we qualified for the Olympics, it was the final play, time was up, and I was able to make that pass in the last play, which made us the score. So you gotta fail, man. You gotta try. And ultimately, if you knock at the door, you knock at the door, you knock at the door, someone's gonna answer, right? So just keep on knocking, and I'm sure someday someone will answer the door, and it will be a good experience.
Great, amazing. Well, I believe we have very, very great advice as an ending, as an end for this expert session. So thank you, Ignacio. Thank you for being here. So how can people find you and they want to talk with
Yeah,
you?
absolutely. So feel free to reach out to me on LinkedIn, of course, Ignacio Villanueva, or by email, which is ivm@l40.com. I'm happy to give personal sessions on valuations, on how to best position your business for a potential exit. Even if it's in 2 to 3 years, I'm still happy to talk to you and kind of give you tips on it.
Great. So thank you, Ignacio. Thank you, Carlos. Thank you, everyone, for being here. So
Thank you.
if you're listening also this or seeing this in a future moment, don't forget to follow Evolve in YouTube and Spotify and here on LinkedIn also. So thank you, guys. Thank you. Bye-bye.
Thank you, guys. It was a pleasure.